I meet people all the time who have a lot of money in money market accounts, aka high yield savings accounts, but they don't know the difference between a money market account and a money market mutual fund. And they also don't know that most of the time they would be better off in a money market mutual fund. So I'm making this video for all of you who want to understand the differences between a money market account and a money market mutual fund. A money market account is nothing more than a deposit account or a savings account, if you will, offered by a bank or a credit union. You receive monthly interest, and that interest will be taxed at ordinary income tax rates at both the federal and state level. The only real pro that I can find for a money market account is that the money market account will have FDIC insurance. There are a lot of negatives that come with money market accounts. The biggest, in my opinion, is that there are no state tax benefits with money market accounts. Then you have all of the hurdles that banks and credit unions put in place in order for you to achieve the best interest rate. They may have account minimums, potentially account maximums, tiered interest rate schedules, slot schedules, a requirement that you maintain a no interest bearing checking account, or that you are limited on the number of transactions that you can perform in any given month, or that in order to get the best interest rate, you have to transfer in a bunch of new money, or you may pay fees if you go below the account minimum. You might see a reduction of your interest rate if you go below the account minimum or over the maximum. The games go on and on with banks and credit unions, and the house wins always. The game is stacked in their favor. So if you want to bypass this nonsense, buy a money market mutual fund. Money market mutual funds are investments that you purchase from a brokerage firm like Fidelity or Schwab. These investments are designed with stability of principal in mind. Money market mutual funds target a $1 static share price with no volatility. They are able to achieve this $1 static share price by using cost basis or purchase price accounting valuation instead of mark-to-market valuation for the investments in the portfolio. The biggest benefit, in my opinion, to a money market mutual fund versus a money market account is that money market mutual funds generally offer a state income tax benefit where money market accounts do not. Money market mutual funds will have a percentage of the portfolio invested in U.S. government securities, generally T-bills. And so the interest earned in the money market mutual fund that is from U.S. government securities is going to be state income tax exempt. So when you receive your monthly dividend from a money market mutual fund, some portion of that dividend will have come from U.S. government securities. At the end of the year, when you do your tax return, some percentage of your dividends are going to be state income tax exempt. It's a big deal. The other benefits to money market mutual funds are that you won't have any withdrawal limitations. You may not have any account minimums, and the interest rate that you earn on a money market mutual fund is generally higher than what you'll earn on a money market account. The negatives with money market mutual funds are no fee transparency, the expense ratio will reduce your yield, and complicated tax reporting. Money market mutual funds are not free. There is an expense inside of them, and you're not going to see it. That's something I don't particularly like about money market mutual funds, but if you shop around, you can find money market funds that have an appropriate fee level offering you a better potential return. The tax reporting on money market mutual funds can be complicated. With a company like Fidelity, for example, you will receive a 1099, but your 1099 will not show the amount of your dividend that came from U.S. government securities. You will need to perform research every year on the money market mutual fund that you hold If you're using Fidelity, I'm talking about FDRXX or SPAXX, for example. And you will need to go to Fidelity's tax library and find out what percentage of the money market mutual fund's dividend was generated from U.S. government securities. And then you will need to make a manual adjustment on your state income tax return. Aside from the expense ratio and the complicated tax reporting, I still think that money market mutual funds are far superior to a money market account at a bank or a credit union. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.